All right. Good morning, everybody. DGIF. Looking at Gamma Lab, they were talking about how we are back in a negative gamma regime, as we can see in this chart above. So keep your eye on the vol. There's a little tail that we use with the VIX when it gets above 20, that the pullback that we're looking at is more like a correction and less like a pullback. It's all just these benchmark levels. So back in the day, you would measure the last high and compare it to where you're at now. And if you had pulled back more than 10%, then it was considered a correction. But if it was less than 10, then it was just a pullback. Nowadays, we're more sophisticated and we can use dealer positioning and GACs, DGACs, GGACs, all that. But still, the old school way works, and it doesn't require having a subscription to sophisticated tools. Like we talked about yesterday, looking at the Fed fund futures and pricing in a rate cut that's been unwound, or it is continuing to get unwound. And it's hard to see that we're going to get a boost in the markets if they are continuing to unwind a potential rate cut. So if the news gets bad enough, we have this Fed put where they will come in and they'll cut, but it has to get bad enough. They have a dual mandate between jobs and inflation. For a long time, they dealt with the inflation side. Then, just recently, all things considered, they started to deal with the job side. But now they're leaning back towards the inflation side, and we just don't have any data, right? We're completely blind. So, unwinding that potential rate cut is one of the reasons that we're having this negativity in the market. And I want to point this out because it doesn't take much for them to go in and start pricing it back in again. It's all sentiment driven at this point. If you think about it, nothing is broke. We don't have any real data yet. We got anecdotal data and we've got, suspicions and speculations, but no hard facts. So, yeah, it's weak. Yeah, we're down. Yes, there's a lot of reasons to think it's going to get worse, but they've got a lot of ammunition when it comes to how much they can cut. If you think about cutting in quarters, if our current level is, say, 375, we'll just use the lower number here, we can get 4 or 5 cuts and we would still be well above that zero level, right? Remember when things got really bad back in 2020, even in 2022, you can only cut until you get to zero. And then what, right? It's not like you're going to go below zero. We're a long ways from zero. So they can pump this market up at any time. They're in full control. Even the selling that we've seen, there's no panic in it. It's very organized and systematic, and there's no herd mentality running for the exits. So just, you know, keep your wits about you. Remember that markets can stay irrational longer than you can stay solvent. That's an old phrase, not mine. All right, we've been keeping track of the CTAs sitting in this range, and they are finally unwinding the position size through a whole new level. We don't know where the selling is going to stop, but it's very likely that it won't just be some massive drop, right? I don't think we should expect something that looks like that. That seems a bit extreme. That was also the April drop, right? Down into all the tariff capitulation when the bond vigilantes adjusted the president's perspective. So we're not expecting it to be that bad, but we do want to keep our eye on them to see when are they going to stop? What's their next level of allocation unwind? And they were heavily vested, right? They've got a lot to unwind. It makes sense that they need to de-risk a little bit. Not expecting anything out of the president today. We're looking at his schedule. Uh, it's a really low risk score. And yeah, the VIX is above 20, but it's today, right? And we need to close above it and then still be above it the next day and maintain it. So right now, we drove up, we pushed through, we're at the line, but it needs to get above and stay above for the VC funds to enact their non discretionary behavior. And we're not there yet. So, you know, if by the end of the day we're still above 20, or if through the day today we get above it in such a way that it seems like we are going to maintain it, like some of these closes back here, then it's likely we'll see that response in the market. But we're on the line. So, putting it on the lower time frame here, you can see we kind of overshot it. Hey, maybe it's going to be a Busby for all we know, right? We need to keep our eye on the VIX. So we do have a lot of Fed speakers today. That's really all we have is these Fed speakers. It's always possible they get some kind of gotcha moment, get taken out of context, misquoted, misrepresented. But otherwise, maintaining an appropriately healthy move into the close is the number one goal. How we close on the week, what that close is going to look like. We are read around the world. China is down the most, but the Dow is right behind it. So they're, kind of vying for that trouble. I say that, but, it didn't sort them in order. Let's try that again. Europe down the most, then the NASDAQ, then Japan, small caps. The wide discrepancy between the NASDAQ and the S&P, keep your eye on that. Those two generally run together. We're talking about percentages, right? If you're newer to trading and you haven't really caught on to this concept yet, you want to focus on percent basis, especially when you're running comparisons of different markets. So you got the NASDAQ on one side, the ES on the other. On a normal given day, how far they've moved up or down usually stays close. 1%, 1.5%, 2%. And the one who's up the most or down the most, we generally would consider that the leader. Well, obviously the NASDAQ is leading, down more than 1.5, and the ES isn't even down 1.25 yet. Well, one of these is going to play catch up. So either the ES drops farther and faster to get caught up with the NASDAQ, or the NASDAQ starts to unwind some of that fall and gets more in line with the ES. There's no reason to guess or assume which one it's going to be. Just continue to look at all the other data, make a more informed opinion about what should be happening. You know, it was supposed to be nice enough today that we get the bike out, but at this point, it doesn't look like I'm getting that bike out. I'd like to get one more motorcycle ride in before the end of the year. We are dancing on the 10-week right now as we speak. We've got heavy volume on this sell-off, which is normal, right? When you get violent downward moves in the market, it usually comes on elevated volume. And we can see that open interest had been really running back up, but now we've turned that corner. This is open positions that are being closed. All right, so earlier this week, we had the discussion about are we or were we going to get a lower high or not? At the time when we were still hanging out up here, that was in question. It's not in question anymore. Captain Obvious. The new question is, are we going to set an equal low, a higher low, or a lower low? By the way, that gap close was really awesome. We talked about it enough. Hopefully you had that on your radar. I know every analyst does it different, but if that's where we closed, then we have to go back to that spot to be considering we've got a gap close, not just getting inside the line. So yesterday afternoon, that was the tag. On the 15-minute, it doesn't look that good, but I thought it did a really good job. That 2-bar reversal there, it's almost like a tweezer bottom or railroad. It signaled a nice pause to that drop. Wasn't sure we were going to really get anything more out of it. And I mean, We wicked down a little bit more, but we really didn't get much more out of it. Except that we're still running those 50s. I know, it's just my own little quirk. I still think we're running 50s. I don't think we're done. And now that we are firmly below the new 50, we're going to the next 50. That's 66.50. Someone asked yesterday, what's the stopping point? Well, I lost my crystal ball and I still haven't got that magic 8 ball, but 65.50 is the going pause point. Nobody is saying at this point that we're going to go here. But if we get underneath 66.50, well, that's the next level. And we're going to run it level by level by level until it proves us wrong. Just like on this run up, we weren't sure if we were going to make it to the previous high or if we were going to put in a lower high, and we ended up with a lower high. So that's what we got. Once we started to roll over and we broke the 20, then we knew that 50 was the next level. And right now, the next level in focus is 66.50, or basically Friday's low. So if we get there and we get underneath it and we continue to move to the downside, then the next 50 is the target. If we don't get down to this low and we instead start to run back up, we have to leave this pivot completely behind for this to be a higher low. So one thing that we could do today, for an example, is what we did on Friday of last week. We could be dipping down and we could run back up and leave a really nice wick down here for all we know, right? But this day would still need to close, and then we would need another day to print so that we could look back and say, oh yeah, that was a higher low. So just leaving the wick behind today won't count. And that's if we even get this little wick reversal that we're looking for. In the big picture, when we zoom out, all of this is just still a part of that head and shoulders that I mentioned earlier this week. And while there's a couple of ways to measure head and shoulders, the textbooks like to talk about 50% and 100%. So I'm just going to turn these others off so they're not distracting. You would generally run the measurement from the neckline to the head piece, which is what I measured. 100% of that head and shoulders gets us down here, not quite to 65.50. Now, sure, I could run it from the left shoulder if we wanted like a more extreme, and that gets us 6,500 and 63.65. But measuring anything like this is just like measuring stuff in the Globex and comparing that with yesterday. We would have to get through the right side before we were able to get through the left side, because the right side is smaller, right? So get through these levels, and if we continue to move, then you put those levels on. But you don't start with the bigger levels because you have to get through the smaller levels. I'm not a big fan of the head and shoulders anyways. Outside of that, you have this. This is the entirety of this topping pattern. We're underneath the half. If we get through 65.50, Then we've got 64.92 cog line and 64.50 as the next two levels lower. I don't think we need them. I don't really track moving averages on the weekly for the indexes other than the 10. So you could turn on your moving averages and check the weekly, see where the 20 is. Yeah, that's what I thought. It's a long ways off. It's not going to help, right? So if we get underneath the 10, that's it. There's nothing else down there, moving average wise, that's really going to help you out. There is a trade strategy that I haven't traded it in a little while, but it's called the failed flag play. We are just talking about this the other day too. Usually it's run over a few days, and then you get this base. And of course, it's a failed flag, so it doesn't go lower the way a flag generally would. Instead, it starts to run back up, which ends up building like either a cup or a bit of a V. V doesn't fit though, depending on how big the base is. And that's what we had back here. And that's the cup, right? We ran it down, ran it back up, and we had an equal high. Not perfect, but we didn't overshoot it and get into like a double top bull trap. So now we're on our way back down. If we build a base down here, laying out that bear flag like we did on this one, but maybe a little more base, that failed flag gives you a trend trade or a swing trade run back up to the previous levels. It can be done in futures or SPY, SPX, whatever, Qs. But it's not a V bottom play. It's more of a put in a base play. And I typically run that measurement on a 15-minute. So like this low that we had put in, this wasn't very much. We would have wanted more than this. It should be stretched out and stay underneath the 786 for a little while, right? To put in some form of a base. We got to get that big enough. There it is. That's the kind of base size we're talking about, right? Like a 100-point base or a 70-point base, really wide, holds out for an hour or two, and then it starts to turn. But when you're talking about a 150 to 200-point run to the upside, keeping track of this setup is worth your time, especially when you can play it on anything. All right, we have a market maker move today, so they are hedging. This isn't my opinion. I'm not guessing. I'm not making assumptions. Now they're already hedged. This is additional hedging, and it's only cost to them. They don't get any. It's not profit, right? So why would they light a fire and throw money in it? Money that they can never get back. It's because they're worried about something. We can see it right here. Well, we looked at the schedule. There's nothing on the schedule for them to be worried about. Whatever it is that is concerning them, it is for today and very likely in the early part of the day. Otherwise, they would wait until later today to put this on. So keep your eye on the clock. the government is stupid and lazy. It will do things on the half hour and the new hour, occasionally on the quarter hour. I mean, well, we know there's a couple of economic data points that come in at like 15 after or 45 after, but most of them land on a half hour and a new hour. So just keep your eye on the clock. Keep your eye on the market maker move to see when it starts to decrease again. This thing only has life for today. It cannot last beyond today because it won't exist. So at some point, it's going to start to decay anyways, just because of that. But that would be later in the day, way past when we should have needed it. So it's very likely to start decaying earlier, sometime around 9:30. Just keep your eye on it. Look to see when it starts to go down. If you don't have Thinkorswim and you don't have that label, whatever broker you have, as long as it has options, then go to the options tab on Thinkorswim. We can see up here the MMM, that's the market maker move. It is derived by looking at the data in today's expiration, the 0-day options, that's these right here. And then it looks at the next contract out. So if you see, we got 1982 and we've got 1732. If the number in the front is bigger than the number behind it, then you have a market maker move. That's it. So on any platform, as long as you have options, just keep your eye on the 0-day and the next expiry out. And if the 0-day gets bigger than the next one out, you have a market maker move. That's it. Thinkorswim was built by Tom Sosnoff and his crew way back in the day, and they made it up. Okay, that's why you won't find it somewhere else. They just was sit around the table drinking beer after work, talking about changes they wanted to make to the platform, and they literally made it up, just like Sizzle. They just made it up while drinking beer after work. So there you go. That's not my story, that's their story. He's talked about it often enough. We're through the ADR half. We're close enough to the ADR full that it's likely we're just going to go on down there and get it done. We have a phrase that says if we get to one side early enough in the day, we can go to the other half by the end of the day. You want to be careful with a statement like that. Generally, we use that statement for getting to the half. If we get to the half early enough, we can go to the other half by the end of the day. But we've exceeded that, and now we're closer to the full. The thing is, in violent markets, we can still go to both sides by the end of the day. We can get all the way down here and then come all the way back up here, and we can go all the way back down again here by the end of the day. It has happened before, so that's how I know we can do it. It doesn't happen very often. And when it does, it really highlights how volatile we are to make those sort of extremes. Remember, this is the average daily range. I built it using a 20-day look back. So it's basically asking, hey, over the last month, what's the average daily move of this market? How far do we typically go on a given day, higher or lower? And the answer is about 1.25, or about 85 points a day, higher or lower. Well, if you split that in half, then you get like 42 points higher and 42 points lower, and there's your 84-point range. But if we just go in one direction, 84 points, we're going to get to the edge of the move because that's what we're measuring. So we can go 84 points down and then turn around and go all the way back up to 0, and then another 84 points in the other direction. That's a 160-point swing from one end to the other. and we can do it. So if we're going to make that turnaround, you want to see a breach of the 786, get back through the ADR half, target the close of yesterday, and then the ADR half on the upside. If we get through that, then we target the RTH open of yesterday, which is also the full ADR on the upside. That's an overlapping level, it's an overlapping pivot. And it's a strong one too. Getting through 68.50 today, I think would be very hard to do. It would have to be something really, really good. I don't think we got anything that good today. Of course, who knows? They're hedging about something. Today's floor pivot is lower than yesterday's. It's worth noting yesterday's very narrow channel. When we have a narrow channel, it implies that breakouts stick and that we continue to move in the breakout direction. These narrow channels don't make price breakout, and they don't make price run. They just give us some insight on the question, hey, if we break out today, should we expect a reversal and to come back inside the range? Or should we expect that it's just going to continue to keep the breakout? Well, today's channel's not narrow. It's really big. Wide channels like this suggest that if we do break out, it's likely not going to stick and we come back in again. Now, again, to be fair, these channels don't do anything. So, you know, whether it actually stays broke out or not, we'll have to wait and see. And it's not a perfect system. This is what we're talking about breaking out of yesterday's range. Well, we're obviously outside of yesterday's range. We have an inside day breakout. We also have a missed daily pivot, and we are underneath the weekly pivot. So any run today to the upside has to get back above 6,700, big round number, 6711 cog line, 6732 cog line, 6750 options level. Then that weekly pivot. Then the 92 cog, 6,800. We got a lot of levels to try to work our way back up. And that's if we're going to make a run. The reason I'm looking upside, though, is we've had a lot of these examples over the years where we're really negative in the pre-market. It's fallen a long ways. Negativity is high. It's all over the media and the news. And everybody comes running in to pile in short, and we just trap them and squeeze those bears until their head pops, and we run it back in the other direction. Those are your levels to run up. You want to grab a screenshot, you're more than welcome to. They're just cog lines and the roundy with the options level at 50. I didn't mark 6,800 because it's already being marked by the floor pivot. Because of yesterday's move, we've got an extended SNR level today. You see how wide it is, all the way up here to 70.92 to 65.02, just for some rounding numbers, right? We're talking, what, like 600 points for that range-ish? That's a really big range. If we were looking for S1 R2, we've already broken S1. So that is kind of off the table. I could have expected S1 to R1, but again, we're already under S1. So getting to S2 makes sense. That's the 6650 that we were talking about earlier. So getting down there and just getting the reset is good enough. We could then, start working our way back up. But there is in the textbooks a discussion about getting beyond S2 when we never touched the floor pivot. And it does open S3 because it's a continuation play. To do that, though, we have to get firmly underneath S2 and then check it from below, kind of like an upside down Busby. Then it opens the door for that run. And that would be 6,500. It would overshoot the 6550. La, 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 la. All right, we are developing a bit of a P-shaped profile. We want to see how this extends. And it's worth keeping your eye on it today, not on this time frame, but on the 5-minute or some other smaller time frame than this, like maybe a 15-minute. But you want to see how the low comes in. Is it defended like it was here? Or like it was here? I mean, look at that top. When they come in, that that just hit a massive amount of sellers, right? Like this up here. Or is it going to be really thin where the sellers just got exhausted and stopped selling? And so we started to buoy back up. That's completely different, right? Running into a bunch of buyers and seeing it balloon to the upside, just swell up with volume here, that would show us buyers stepping in and really running it back up. But exhausted sellers is not the same thing as aggressive buyers. So keep our eye on that today. If or when we start to see that reversal, that's what we want to be keeping our eye on. Otherwise, the point of control is a long ways off. We've made it through anything that may have helped us. And even if we zoom out, the last structure we had was back here, and we're already underneath that too. And that was the big one, right? That's the one that expanded through all of those weeks. Point of control, point of control, point of control, all of those. And that's what we're getting tangled up in right now. So if we lose that, I like 6650 and I kind of really like 6550. But let's see how that reversal is when we get down into this low and what it looks like on the volume profile. Looking at the anchored VWAP, we are below October. Next level down is 66.50. All right, we're expecting this point of control to move very likely Monday, maybe Tuesday next week. It's a lot of trash all through here. So unless we build out a new area to land in, wherever we do go, it likely doesn't stay there very long. We could just skip through these levels a few days here, a few days here, as they slowly get wiped off the board until something dominates. To get that dominance, we need to stop and kind of hang out a little bit. Something that looks like this, or, maybe like this. So we just hang out somewhere and we put in some work. We started to put in some work here, right? But then we gave it up. That was looking like it was going to be a failed flag, and then it didn't fail, right? We went ahead and continued to the downside, but that's exactly the failed flag setup. Let's just use the low, where it sits inside that 786 and it builds out a base, and then it comes back up. But we didn't come back up. In the textbooks, when you're measuring these moves, you can measure this distance and you can measure this distance. And then you take that measurement and you stick it down here. And that's your next stopping point. And then, of course, for the pullback, that would be the pullback of your next depth, right? So it is a 111 of this move is our next stopping point. Doesn't that make perfect sense? Because 111 is where the reversals come in. Imagine that. So we break the previous low. We overshoot it into a bear trap, tangle up the 111, which gives us an inverse cup, or a double bottom bear trap, rip them back up to the upside. I like it. But we got to get down there first. 66.50. That would also give us the depth we need for a little bit of capitulation, because we're really missing that. There's the November 7 VPOC. We're done with that now. But as I've mentioned before, if you hit it this day, it's worth keeping it on your radar for the rest of the day. So we're going to leave it on there and take it off Monday. If we had hit it yesterday, then we'd be looking at it today and I would take it off. But we hit it today, so we'll be looking at it on Monday and we'll take it off then. As for yesterday, we didn't get a new VPOC because we opened there and we cut it up before we moved. Look at the profile here. See all of this across this high with this point of control. We want to see, what does this low look like if and when we put in a reversal today? Is it going to have that kind of depth to it and that kind of character? Or is it going to be really thin and shallow and we just run back in the other direction? Not that it always plays out, right? Look at yesterday. That's where the greatest amount of volume is. It's where the point of control was. So we landed down here and we got a lot of volume, which generally would make us think we ran into a bunch of buyers. Buy side liquidity sitting down there. If that's true, it didn't stop anything, right? But that was the gap close, that shallow area. And on the other side of the gap close is where all that liquidity was. So it held us up. It stopped us from falling deeper yesterday, but we washed it out with Europe's assistance, and now here we are. So any move back to the upside now has to deal with that and today's point of control. We do get a preview of next week's range. This is not set in stone. We're going to need to review it again on Monday. But we can see that next week's range has more volatility priced into it than this week's range. Now that's a little misleading and sneaky. If it was economic data, CPI, PPI, non-farm payrolls, FOMC, something like that, it actually wouldn't be wider because those are volatility suppressing events. When it's wider like this, it's an unknown unknown, not a known unknown. So they're worried about how bad things could get next week, and it's getting priced in. The reason I like looking at volatility tools like this is because it's using trades that are coming in the options. This isn't some analyst's interpretation of the data. It's not some paid actor coming in and giving us their insight or their point of view. It's looking at money spent, positions held, and asking, what are they doing right now? They're pricing in defense and they're expecting volatility. Follow the money. So the range next week is wider because traders are pricing it in because that's what they're expecting. The options that they're trading is expecting bigger moves. It does not mean we're going to get those bigger moves, just that they're expecting it, that there's that kind of worry and fear into next week. We'll look at it again on Monday and see what the range actually is, because right now it's just a preview. We're more than 1.5% below the 10-day. I run two imaginary collars here, one at 0.5 and one at 1%. So 0.5% above and below and 1% above and below. We are well outside that boundary. We don't generally hang out too much underneath that level for extended periods of time unless we're in an extended bear market. Go back to, say, 2022 bear market, you'd see that we were below the 10 quite a bit. Or say at the beginning of the year this year, from January into April, things were pretty nasty and we fell a lot. We stayed under the 10 quite a bit. So when we have a lot of negativity in the market and we're below the 10 and we're staying underneath it, that's when we would see this. Otherwise, what we get is oftentimes these one-day wonders where we drop 2.5%, 3% below the 10 and we run right back up again. We don't know what this is going to be yet, but it's not deep enough to think it's going to be a knee-jerk reaction rip to the upside. I use this indicator to ask a very simple question. Have we moved too far, too fast? And if the answer is yes, then the next question, should we expect mean reversion and or some sort of move back towards the mean? At this point, the answer is no. We have not moved too far, too fast, and it does not owe us any sort of mean reversion. Not on this time frame. Now we could go to an hourly or something like that, and you could always argue for another time frame, but if you stay consistent on the time frame that you're using, this says we're not oversold. We're good. We got plenty of room to fall before we need to worry about flipping back the other way. got a lot of things on support. The only way you get to support, right, is because you fell down to it. There's a really great phrase that said markets crash in an oversold state. Yeah, you've heard that before somewhere, I bet. They don't crash from all-time highs, right? They crash when we're in oversold territory. And we're a bit extended to the downside. And it's possible that we could crash from this extension to the downside. But I'm still going to argue we're not quite oversold yet, at least on that daily. So looking at things that are down this morning, which is pretty much everything, there's no reason to name them all. But things that are down and not yet down enough, financials, industrials, emerging markets, which is basically China, those are down, but not enough. Look to see if we get some sort of capital rotation, a flight to safety into staples. So we would want to see money flowing into healthcare, XLP, XLV. It used to be XLU, but that's now tied to AI and data centers, so we can't use it as a flight to safety. I've been putting a lot of thought into this, and I don't know, like maybe nat gas or something, but really everything energy is focused on AI. So I wouldn't even really want to go into something like solar or nat gas or coal or anything that's energy. It's freaking AI now. So I don't know what to replace it with. We would expect to see money flow into these other two, healthcare and staples, because we're looking for a growth to value rotation. The thing about this rotation is when things get negative out there, everything falls, right? It's just that value would fall less. That's the prevailing wisdom. And if it was an extended negative market, like a 2022 bear market, for an example, then over time, we would expect the staples and healthcare and that sort of stuff to start to perform better. But we're not in that extended thing. And as we can see in the market watch this morning, with everything being down, if you look at what's up, we got nothing. There's your XLP, but it's not enough. So now we've got the VIX above 22. If it begins making a move to the downside, we want to get back underneath that round number of 22 and then 20. There's no middle ground for me on this. Get underneath the 22. That would help. That'd be a really good start. But then we got to get straight beeline to 20, and we got to get underneath that 20. If we're screwing around anywhere above that 20, then it's really hard to see a market rally this afternoon. You can add that this is the weighted AD on the bottom here. This is just the NYSE tick on the top. The weighted AD, I have these imaginary levels at minus 250 and plus 250. And you can kind of see it back here when it got into that 250 level. And then it finally broke that and it started to get worse. When we're underneath the minus 250, that's straight up selling. And I don't look to see any sort of market rebound or rally until this shows significant effort to get back above that 250. And if we're bullish, it'll be above positive 250. It'll be up here. So when we get into the open today, this thing doesn't do a good job at the open. You can see there's not a lot of work. But by 10:30, it really starts to kick in and get some work done. Keep your eye on market breadth. What names are up, what names are down, how much they're up, or how much they're down. You can use TradingView or Thinkorswim for this. This is how many names in the S&P 100 are down at least 0.5%. And since you're using 100 names, the answer is something you can turn into a percent. So 59 names are down. So we can say 59% of the S&P 100 is down this morning, at least 0.5%. And that is bearish, but it's not as bearish as it could be. I've seen that get into the 80s and the 90s. High correlation coefficient. We're not there yet, which continues to imply that we could get worse. We could get negative again today because we don't have enough of the correlation to flip yet. But if you keep your eye on it through the morning session, if we do get that high enough number, we could perhaps get that flip in. And then there's the NASDAQ with only 54. 54% of the NASDAQ 100 is down at least 0.5%. That's a little bearish, but not as bad as it feels, right? It feels like it's really bearish out there. This says it ain't that bad. All right, so let's wrap it up. GTFO, always. You have to get out of the box before you do anything else. This is the range that we have. That range has already extended outside of yesterday's price action. We have to get back inside of yesterday's low and then outside of our own Globex high. And even at that point, we would still be focusing on yesterday's RTH mid 6,800. And then we would be focused on all of yesterday's mid 6,820. So we got all of these levels to the upside. And the half back of our own Globex range. So we can add that to the resistance or the level we have to work through to the upside. All right. To the downside, we've got the next 1, 2, 3, 6. And then we update the drawing and we run another level until we get down to Friday's low, 66.50. If we break that, then check where the levels are at out here. Go back to your daily. So underneath that, we've got the 6,600 and that 65.50. There's no moving averages. There's no help. There's no assistance. It's just going to be the options and the roundies. All right, level by level. Just keep this market signal right here. Keep that in your mind. That was last Friday. We get those sort of reversal moves, and they're fantastic when we get them, right? They feel really bad at the time. They look really ugly, and they're scary, and then we flip over and we run it back up. And everything that we've seen is nothing more than sentiment driven, right? We don't have any data. They're unwinding the Fed rate cut and there's some nervousness and there's issues with Bitcoin. And I mean, there's a lot of things, right? But all it's going to take is a little bit of a headline, a little bit of shift in sentiment, get that warm, fuzzy feeling, and we can get a V bottom or a 786 base, and we can run this thing right back up again and get one of these graveyard bars or doji bars, dragonfly bars. I don't know, there's so many dojis that I lose track of them all. But if we can get one of those, all right? So everybody, be careful, be safe, have a good weekend. Watch the clock. Watch the clock. I'll see y'all next week.